The last session before lunch, and it's beyond traditional finance, the unstoppable rise of digital infrastructure. The evolving capital strategy is essential for a scaling data center infrastructure amidst a rapidly changing economic environment to continue to attract billions of capital, no matter the geography. Industry experts will dissect the roles of private equity, bonds, debt, and emerging capital sources in driving growth and innovation. And to share the session, and who will introduce this panel, is Barry Cross, Simmons & Simmons Partner.
Thank you very much, and good afternoon, everyone. I'm aware that we are running slightly late, the panel is aware of that. As well, I'm Barry Cross. I cover the data center sector practice at Simmons & Simmons, a global law firm. I'll just quickly introduce the panel and we'll get straight into it. So immediately on my left is Finn Tran, who is from SMBC, followed by Wes Cohen, who is at Applied Digital, Jack Martin at Goa Capital, and Frederick Muller, who is at Enlighten. Who, as you can see, we have a very broad range of panelists, both geographically and also in terms of their stakeholder interest in the sector. There's no doubt that the sector has seen significant change in terms of the capital that has been flowing into it over the last 15 years. I think, Quinn, we can start with you. If you could maybe provide a brief history as how we got to this point in terms of data center infrastructure finance.
Yeah, history sounds like a very long time period, but actually the history of financing in the data center space, at least in the part that SMBC has been a part of, has been relatively short. It's been less than 10 years. We did our first, or the first, project financing of a data center in the Americas just about 7 or 8 years ago. And at the time, I think some of the other panels mentioned that data centers are moving into infrastructure. So our team covers infrastructure. So at the time, our client came to us and basically presented us with a 15-year contract with a hyperscaler. It was the first ever lease that we've seen. But also, it was a client, they were extremely excited because it was the largest hyperscale lease ever signed. And based on the numbers today, if I told you that lease was 20 megawatts, that was a very big lease back then. And that financing was about 200 million. And so for the next maybe 3 or 4 years after that, a lot of the financings that we did were in the 100, 200 million range. And so SMBC was able to do that on a bilateral basis, or really just find 2 or 3 other partners to work with us. Fast forward to really very recently, 2022, we did the first, what we believe, widely syndicated project financing of a greenfield data center. And that was for 100 megawatts, so that was maybe 4 years later, it went from 20 megawatts to 100 megawatts. And at that time, that was also a very, very big lease. Total financing was about 850 million. Since that first deal until today, just SMBC alone, and just in the Americas alone, we've led more than 35 billion in greenfield construction financing for data centers. Our colleagues around the world have also done financings to a lesser scale in Europe and Asia, Australia, and so forth. But that number has grown. It has consistently been, and again, just for SMBC in the Americas, about 5 billion or more per quarter. And we expect that trend to continue. So what we're really feeling responsible for this year is our work has doubled. We need to keep pace with the continued greenfield financings, but also to make sure that the assets that have stabilized, because the construction periods are only about 2 or 3 years, to make sure that the assets that have stabilized, that will be stabilizing this year and next, are taken out successfully, and we can go into that later on, in the U.S. private placement market, private credit, ABS, to ensure that the bank capital is still there. So SMBC is working with our clients globally across different product groups to make sure that those refinancing vehicles are available. And I'll just add that we've all been able to do that because inherently this asset class is very strong from a credit perspective and from an industry tailwind perspective. So there are many, many players looking to find an opportunity, and we're working with them to kind of see what works and what doesn't work for different groups of investors.
Great, thank you. I think sort of brings out a lot of different points, and you mentioned obviously the need to recycle that capital and you referenced ABS. And Wes, from your perspective, how are financing vehicles like joint ventures, ABS, are they reshaping the digital infrastructure financing landscape?
Yeah, thanks Barry. And this follows really nicely on with what Quinn was talking about. The scale of what we're seeing now, and sorry, our company's a developer and operator of large-scale data centers. Our campus that we're working on right now is, we have an initial 100 megawatts to come on this year, 400 megawatts by early 27, and that campus eventually scales to $1 billion, and we have several others that we're working on as well. So the size of this and the scope from a financing perspective is immense, and what we have done to solve that is earlier this year we announced a joint venture arrangement with Macquarie Asset Management for the equity portion of the financing of these sites. It's a $5 billion total capacity facility, which will allow us to go to about 2 gigawatts across the campuses that we're developing. So I see that portion, being very important from a joint venture perspective. And then the follow-on with companies like SEBC for the project finance. And then as far as ABS, I think as Quinn mentioned, that's yet to be seen. In this market, there's going to be a lot of ABS hangouts in the market over the next 2, 3, 4, 5 years. So we've focused on putting these and other companies that are going to put these types of facilities in place to be able to scale quickly because the demand is so large, the campuses are so large, the individual deals much larger than they have been even 5 years ago. And the market keeps evolving very quickly. We can dive into that later, but the move from hyperscalers to directly frontier model developers that started a project, the market keeps changing rapidly and evolving rapidly. I think that there's going to be a need for even different financing solutions to meet the demand of the market.
Yeah, I think you talk about the evolving market, and there's generally been a trend that something starts in the US and moves into Europe, and the US size-wise is significantly bigger. And Jack, from a European perspective, is Europe a long way behind the US in terms of alternative structures and approaches, or actually side by side? What's your perspective?
I think a lot of the capital structures have been pioneered in the US, and we continue to see that trend. The ABS market was opened up in the US and running for a few years before being brought over to Europe. The complexities of different regulations and structures for enforcement here just mean that first, the structures, are more broadly marketed in the US. And so in Europe, what's great though is that there's a lot of capital that needs to be deployed and a good appetite for continued investment, including in ABS. I think yields are attractive as well.
Barry, I think one of the things that helps a lot of these financing vehicles get exported relatively quickly is, for example, when we work with staff in the US, then we work with Jack and his team in Europe and other teams within staff and Luau in Asia, and all the teams at SMC and our clients are speaking together. So it's the same client really, going global, building globally, and kind of using lessons learned in the US on the operations and construction side, but also on the financing side, and saying, hey, we did this in the US already. What are some of the differences in Europe, and how do we make sure this works in Europe? And we understand that it will take time, but we know that it can be done, because going back to what I said, just inherently this credit is so strong that you just need to spend the time talking to the rating agencies, talking to the investors, but you have a very, very good product to sell.
So it's very much that globalization factor helps the transition of what's been tried and tested in the US and moving into Europe.
Just one thing to add on that, I think you have to look at the pool of assets, the asset base in the US. versus Europe and APAC, where in the US there's much larger campuses that have already been built out and stabilized. And so in Europe, we're partway through that build out, and as those assets stabilize, then you'll see these new structures continue to come to market, both on the debt side of ABS, but also with equity.
Yeah, I mean, the size in the US is big, but certainly the stabilized nature of that system has to make a difference. And I guess from a operator's perspective, on the outside looking in, there is just this wall of capital that is coming for you, and that seems great. But what are some of the challenges as an operator in terms of actually being able to get hold of some of the capital?
So we're 100% European, so our focus is on Europe. We're 34 sites now, M&A driven, brownfield sites that have been smaller, 3x to 5x, with the ability to scale up to 10x. So when we were doing our M&A, when we were looking at speed to market, that drives sort of our credit decisions. So the private credit is a little bit more flexible, quicker to market. If we have to go down to structuring, more structurally, there's a lot of complexity there. As a team, we are 2.5 years into our journey. We're relatively small, backed by outside capital, very knowledgeable structural investment. We do leverage that, how we run our small teams. So we're looking for simple structures at this time in the growth sector. Also, we need to align our interests, obviously, across rapid growth versus that risk profiles that we have. And our customer base, we're 1,000 customers, who ranges the whole gamut. Right? So from public sector, mid-market, AI platform, the whole range. So we're quite diversified on that front, which for some lenders is something that needs to get ahead of. We're not coming in with a 10-15 year contract AAA. We have a broad range. It has its benefits. We're certainly seeing now that a lot of lenders are looking to diversify their portfolio. A little bit overweight on hyperscale. It's starting to look more broadly at what's out there. So that's an advantage for us. We also obviously with 1,000 customers, Microsoft has a complete 180 or something. We're not so exposed. And that also brings up the AI conversation. What are you building the right data?
Right. Yeah, I think you are a very different business. You're much more of that smaller colo kind of solution. And I guess, does that mean then that a lot of this conversation around the big money passes you by?
The numbers keep getting larger and larger, so when we're talking about big money, we are deploying 100 million of CapEx every year. With 34 sites, we're scaling up to 80 or 100 sites, that's our target, across the whole Europe. The amount of CapEx that's going in there, it's a bit of a more complex piece. It's not as simple, it's simple because I know it's not simple. But we're not building 200 megawatt sites every site, getting funding against that. We're building 34 sites. We have 34 projects, and those projects may be multi-megawatt, collectively add up. So,
right, so the amount of capital.
It's a little bit more complex in some regards, but it's less complex in others.
Right. Just coming back to you, obviously you are a traditional lender. There are a lot of alternatives coming into the market. So what alternatives are particularly attractive to you as a traditional lender to partner with and help deliver these sites? Because some developments so big, right? No one's doing it alone anymore.
I think there's definitely more than enough to go around. So as SWC, we're a Japanese mega bank, and we got into the space mainly through the construction financing, but we really have built up an entire ecosystem around this. And so, for example, we're very excited about the US private placement market. That market, I think, is known globally for financing big infrastructure projects. Historically, has financed multi-billion LNG projects, also projects globally. So last June, we worked very closely with our US private placement team to do the first ever US private placement of a data center stabilized asset in the US. There's only been one done, but it went very well. Though there was a lot of work that went into it. We spent a year and a half talking to the rating agencies, basically pulling our hair out, saying, if you could rate a toll road in Texas investment grade with significant traffic risk, and by the way, greenfield toll risk investment grade, I do not understand why a data center with a hyperscale contract, with Microsoft or Amazon should not likewise be investment grade or even in the A category. The problem is that they were using, this is the US private placement, this is not the inflation methodology, they were using rating models that fit more into other infrastructure asset classes. So we had to work with them. Eventually we did get to a new rating, and when we did the first transaction just last June, it was for $550 million. The order book was $3.3 billion. So the investor, I think someone said in the other panel, the investors are there. We just have to do product. And so now we are working now on other US private placements, not just in the US, but also in Europe and also in Asia. Likewise, for the ABS market, that market has been there for data center securitizations, but mainly more for portfolios or co-location. What we really need to solve for this year and next are these big hyperscale projects, right? $1 billion project is relatively small now, but the largest ABS and data center is probably about $1 billion and a half. So how do we get that number bigger within ABS, and how do we get the rating agencies, and they are getting there, more comfortable with single assets, single tenant risk versus historically more like diversified. So there are many different avenues that can be taken. Really, it's just the work that needs to go into it. And then private credit is another topic and another avenue that we also tap to kind of add on to the capital stack, maybe at holdco level or maybe for tenants outside of hyperscale.
I think, again, the theme that's coming through it, I think it comes through consistently is actually around education. Whether it's educating the rating agencies so that they understand what the assets are in their rating, so they can get the right rating, or whether it's educating the investors, or the newer entrants in the financing space. The sector has always struggled with this challenge. People don't really understand what the sector does. Jack, just from a geography perspective again, so I do want to recognise we've got US, we've got Europe, we've got the rest of the world. What role does geographic diversification play in capital stack strategies?
I think Barry Buffett said it best. Diversification is useful to hedge the risk of ignorance. And so at Blue Owl, we're focused on being strategic partners to hyperscalers. We're having high-level conversations globally, talking about demand and their requirements over the long term. But I think if you're a new investor coming into the space, you need expensive diversification, because otherwise you're being asked to pick winners and losers in an environment that is probably challenging to unpack if you are looking to just make one allocation amongst many within your investment portfolio. And so I think on the product side, to what you were talking about, when the ability to bundle multiple geographies and diversify away the risk of something idiosyncratic with your allocation in the sector is increasingly important.
So is that the case of we need to, because the size of individual projects is growing, the investor pool is growing, but actually what I hear you say is that you really need to be able to break those projects down into smaller little chunks so that investors can diversify, because otherwise the check size they're having to write on a single project is, or potentially to a single opportunity that might be across a number of projects. There might be one particular customer or one particular developer. That risk is too high.
I think everybody ultimately, if you're going to allocate lots of capital to data centers, is going to have to be comfortable with customer concentration. There's so few hyperscalers that are leasing, participating in, the build out, the infrastructure build out that's ongoing. So just back to the numbers, 325 to 350 billion CapEx this year. just with the 4 to 5 biggest hyperscalers being invested globally. And so the ability to participate in that and have a broad enough allocation that's not overly concentrated for the medium to long tail investors that are interested in participating in spaces is going to be important. And I don't think that we've candidly as an industry figured that out on the product side yet.
So it's really not just breaking them up for the benefit of the investors' diversification, but really for the benefit of the developer as well. Because if you have a $3 billion project and you're faced with a refi in 3 years, it's much more difficult to refi $1 billion than if you had basically thought of it from the very beginning. How do I parcel the land? How do I draft the credit agreement? How do I make sure all of the underlying contracts are such that I can actually break this $3 billion project down into $1 billion pieces so that I can take out $1 billion in this market, maybe $1 billion in another market, sell this piece to someone else. So we're already starting to think about that even before the construction goes up, because 2 or 3 years past is going to be really good.
Right. Obviously, the geographical diversification, you either deal with multiple different jurisdictions. There seems to be an ever-increasing risk curve on every jurisdiction you go into. Even supposedly safe jurisdictions we see now aren't necessarily averse to throw a few curveballs. For the first one, from a platform which is very diversified geographically in Europe, in the EU, I think people often make mistakes thinking the EU is one system, when in reality it often doesn't operate on that basis. And are there any specific financing challenges that brings to raise finance as an operator of multiple jurisdictions?
Yeah, I'm from Switzerland, so it's 26 countries around. We have a portfolio that ranges across around the UK, Germany, France, and they all present quite a number of challenges to work around. So, I'm not going to go into too much detail on this, but always using. We looked at a number of different options around that. We'll stick this into private credit in our growth markets. We're not quite at the stage yet where the YieldCos stabilize businesses and require that. We're still much focused on the development side. We have to be careful around that. But
So the challenges are there, whether from a more US perspective, obviously you're in one jurisdiction, albeit lots of local jurisdictions as well in the US. And how do you manage that challenge around the uncertainty that we now face in geopolitics? To what extent, even if you're just in the US, to what extent are you impacted from a capital raising perspective?
I would say we're probably the least impacted. From a demand perspective in the market that we are focused on in mostly AI workloads, almost everything from a training perspective is happening in the US. The companies are all US based. Politics definitely make it harder to do business with certain companies. There's a very popular social media company around the world that it's really hard for us to do business with in the US. But for the most part, for the things that we're focused on, it's the political environment, the geopolitical environment has a pretty limited impact because everything is happening inside of the US. The bigger impact when you look at trying to diversify from a geography perspective, that's important. Obviously, Virginia is tier 1 and the biggest market in the US. There's a lot of other tier 1 markets in the US. But as we have been in the market for the last few years, the thing that is much more difficult, I would say, to navigate is, back to Jack's point on the amount that's being spent by the top 5 hyperscalers. When one of those hyperscalers takes a pause, it has a big impact on the market. And we've seen what I would call kind of a musical chairs. And from my understanding, this kind of always goes on one. So you have one hyperscaler go back, maybe two, one comes into the market. There was one hyperscaler we didn't see at all last year. I don't think hardly anyone saw last year, and now they're in the market, and the other ones are out. And then there's this really big underlying demand piece that drives the market in a big way overall as well. And so you have, and that's the frontier models, right? And the frontier models driven by mostly OpenAI, by far the largest. Who's doing business with OpenAI? OpenAI started, before it was, last year was Microsoft doing a lot of business with OpenAI. Now, they're building that side of the Avalon. So there's kind of this rotation of demand. That, in my opinion, is the hardest piece to manage in the US versus geopolitical or even geography. It's just that when it's so concentrated with so few players, it's not like a traditional market where you start to see kind of overall demand slow down. Demand might be stronger, as strong or stronger than ever, and you can still see kind of these waves of the market because it's just such massive players.
And maybe Wes can add to this, but in the US, the other thing is really because there is so much build out and so much demand on the grid, it's really making sure you manage the communities, right?
Yes.
Because you are building 1 gigawatt power plant data centers and more so maybe the related power sources in certain communities using the grid and putting demands on power for their residents. So making sure that messaging is controlled, and especially for AI workloads, that's similar to what Wes is doing.
Yeah, and just to go back to that, these types of things tend to be, a mix of inference and training. So there's certain type of inference that go into training style infrastructures, especially when you're looking at image gen or video gen from a use case perspective. But a lot of training, and if you look at the training market, OpenAI wants to spend $40 billion a year by 2020 on what they call R&D, which is training for the most part. And so, $40 billion a year from OpenAI is like 3.5 gigawatts, and these are better if they're really close together. And we're only going to do these in more rural locations. And so that's just OpenAI. Even if they're 50% of the market, it's 7 gigawatts. Almost all in the US. Maybe it's not 28, maybe it's 1/3, but still a huge amount of power to build out. And it's going to be in smaller communities. That's where we operate. We're building, like I said, 400 megawatts now. Campus it goes to 1 gigawatt. The town next to it is 1,100 people. So managing those types of geographies is actually very difficult as well.
So I find it really fascinating that effectively from your perspective, the US geopolitical is far less of an issue, right? It's the headline grabbing news, the reports that this hyperscaler is suddenly producing, and on that you also know a lot about the AI, right? You sort of bring Jack in front of the discussion. Is there a problem that the focus on AI has had a negative impact because whenever there's a bad news story about AI, that's what grabs the headlines. Everyone's forgotten about cloud, or actually no, the clouds, well, we all know the cloud's there, but from a public perspective, then it's all focused on AI, and therefore if your focus is cloud, it's more difficult.
Yeah, cloud is no issue. I mean, the issue on the funding side. I think when you touch on AI, you see a lot of different. You see the FOMO fear of missing out. So a lot of lenders are really keen to get into that market. And what happens is you get ahead of the curve, where you're really starting to price in not stabilized returns and price a little bit ahead of future demand. Obviously, also the profile of the tenant is something that's quite significant. We have some of the clients who are very careful because we just don't know them well enough. We don't have the history, the track record that we have with the hyperscalers. That also obviously on the lender side, that's refinancing risk against the high pricing. So it's really about getting the hype and the timeline worked out. Very minimal hype. We're certainly on the inference side of the business, so we're a little bit behind all that's going on the massive deployments that we have with learning, but we're preparing ourselves for that. Obviously developing insights. I was amazed that we've been now now fit a 3 megawatt set of racks, a row of racks in less than half the size of this room. So the space is becoming much less efficient.
It's just the ability to deal with the heat and
The data was
yeah.
the thinking of a lot of space, we reduce that down. We have a lot of equipment which doesn't. It fits perfectly covered. That's what I'm trying to get at.
And so what's your experience on the discussions you're having? Do you find that the credit that's coming in understands that there is this difference between whether you're financing something which is fully AI focused versus fully cloud focused versus a mixture?
I think people who have been in the business for a while understand the fundamental differences between the cloud as it traditionally was and then what is changing currently for AI. I think back to your earlier question, Mary, about public perception and the headlines, I think the hype around AI deployment has brought a lot of issues to the forefront, and really what we need to do as an industry is articulate our social impact and our the value that we bring as digital infrastructure to society and to local communities more effectively, where the nuances between what's an AI workload and what's a cloud workload are less significant than the fact that we're building huge infrastructure projects in new places. We're continuing to deploy infrastructure into places where there's constraints to development already, and so what we need to be talking about is how we're enabling the digital economy and the build out and development of all the AI and cloud services that are happening within the data centers.
I just want to update on the negative news headlines of the year. And I would classify this year so far as kind of good news for people who like bad news in the AI world. So we went, since ChatGPT was introduced in 22, which has been nothing but extreme bullishness, and then the DeepSeek happened in January. Right? And just to put that in perspective, so ChatGPT, fastest app that goes to 1 million users, 5 minutes is what it was. And is it going to be a novelty, a flash in the pan? So by December 24, GPT has 300 million weekly average users, so growing really nicely. DeepSeek hits January. DeepSeek goes to #1 on the App Store for Apple. In February, GPT has 400 million weekly average users. From February of this year until May of this year, GPT with the introduction of 4.0 goes from 400 million to 800 million. And DeepSeek goes to, as of today, like 165 on the App Store, and ChatGPT is #1. So I feel like there's a big exaggeration. And on ChatGPT, which is the query of AI is far and away clear. Queries per day as of May are a billion. That is 2.5 years from introduction to hitting a billion queries a day on the app. To put that in perspective, Google took 13 years from the introduction of Google until it started hitting a billion queries a day. And then when you break that down further, a single query on Google takes about 1,000 to 10,000 flops of compute power to process the query. OpenAI GPT takes 300 billion to 1 trillion flops per query. So just back to the massive amount of compute that's needed. But there has been a massive amount of kind of negative news. It just feels like we're in that cycle at the moment. Maybe people click on negative news items and positive. It's kind of the underlying trends that we see just with OpenAI, and then I'm not even going to get into all the other applications that we're going to see that are massive AI infrastructure users like noise that will be happening later this year, next year, and after. So I would just point out that the underlying trend here is extraordinarily strong, even with kind of the tumultuous markets we've seen so far this year.
I'm really conscious of time. I never want to keep people from their lunch, and I think that's actually a really, really positive note to end on. There is little doubt, regardless of all the negative headlines. And I think you're right, Wes. Bad news sells, right? Everyone loves a negative headline. Unless people do like pitching cats, which is a separate issue. But the reality is that even if you accepted all the negative news at face value, the trend is clearly still a relatively steep curve upwards, and that's going to mean we need more and more capital driving a sector. We need to be able to recycle that capital. And it doesn't matter where you sit in that stack or where you sit in being a deliverer of the energy. We're going to see a lot more business over the next decade for sure and beyond. But thank you all for your time, and we'd like to thank you for your work. Thank you very much.